Hello everyone, welcome to SFC Markets Finance. Since January, the Federal Reserve has caught all the attention. Hawkish Fed signaled it may have to hike rates sooner. This shocked the market. At the same time, China's central bank began to lower rates. How will different monetary policies affect the market? And how will global economy perform this year as the society is better prepared for the potential COVID-19 waves? Now, we are inviting UBS Global CIO, Mark Haefele, to join our discussion. Hello, Mark. Glad to see you.
Hi, everyone. I'm Mark Haefele from UBS, and it's a pleasure to be here with you today.
When looking back to 2021, what keywords will you use? Why?
Well, I think it was a year where the economy proved it was very resilient, but it was also uneven for the markets. And I think the way to think about this is resilient because of COVID, resilient because of the government intervention that took place globally in response to COVID. But that government intervention was also something that drove the unevenness of the economy as governments shifted a little bit in where they wanted to put the focus in terms of various sectors, say in tech or in healthcare. So there is this mix of really extraordinary resilience in the face of the global pandemic, but a little bit uneven as we saw it play out in markets.
Inflation rose quickly in 2021. What will happen if inflation remains high in the long term?
Well, inflation remaining high is probably the biggest risk for the economy and for markets. And because that would represent a very large shift from what we've experienced since the great financial crisis. And I think that the major fear that is out there in the markets is that a strong level of inflation that doesn't come under control with the expected policy measures and the reopening would drive policymakers to an even stronger response, and typically hiking rates until the economy rolls over and starts a recession is something that we have to worry about if inflation stays strong. That's what has happened at times in the past.
You mentioned that this year will be a year of two halves. Could you explain it in details?
Sure. So I think, if we think about this growth dynamic and this inflation dynamic, we expect that as economies reopen and the excess savings that's out there gets spent and businesses start to restock for the reopening, the economic growth is going to be well above trend for the first half of 2022. And the inflation is also going to remain at elevated levels for much of the first half of the year. But then as we start getting into the second half of the year, we would expect that some of the excess savings and some of the stimulus measures will have worked their way through the economy, kind of taking growth towards more normal levels. And then the inflation should also start to come down as we get a shift from people buying lots of things, which is really causing supply shortages for some of the materials and goods that people want to buy, as they shift back to services, restaurants and travel and things. As the pandemic eases, that should normalize a little bit the inflation rates across the economy.
How about the supply chain issues?
I think that is definitely part of our thesis around the normalization of inflation rates as we get further into the year. We've had situations where bottlenecks at ports for example, have constricted the supply, or the pandemic has interrupted the flow of chips, really to various value-added goods around the world. And that has caused these supply chain issues. And that's where we really see the cause of much of the inflation that we're seeing. So as we reroute around those supply chain issues to some degree, that should help ease inflation. Now, we're certainly also aware that we're probably not going back to the peak globalization that we had several years ago, because the supply chains had grown so international and so tight that companies, don't want to get caught out again the way they've been caught out in this crisis. And so we talked to a lot of companies that are trying to localize more of their supply chain, and that's an ongoing process. It can add expense. It can also add capital expenditure, which adds to economic growth, and it can also add some inflation as these things reach a new equilibrium.
You expected year-over-year global GDP growth of 4.7% in 2022. What will drive the growth?
Well, as I mentioned, in this year of two halves, we have the focus right now on people buying a lot of things, and we expect they'll shift to buying a lot of services. And when we think about just how much of Asia is under lockdown now, and how here in Switzerland there is reduced purchase of services. It's difficult for people to go to restaurants and travel. As that opens up, that's going to be another source of growth in a different part of the economy in the second half of the year. So we think that can still be a strong driver for growth through the year. And of course, while policy is tightening, if the inflation starts to come down, that pace of fiscal and monetary tightening could be relatively gradual, and give the time for the economy to still grow without a kind of disruption of a recession or something like that.
What are the downside risks to the growth?
There's always risks out there. I think the biggest one really is this inflation picture that you've rightly highlighted, because it does create an unfamiliar situation where policymakers could make a mistake. And it's easy to make a mistake now because bond yields are at historic lows. We have government bonds trading at negative rates or zero rates or close to zero rates in a large part of the world. And that means that the role of bonds going forward for portfolios or the ability of policymakers to use bonds for interest rates policy is different than it was in the past. And so really a policy mistake is probably the biggest risk. Other ones, of course, include a resurging COVID, new variants and things. And then finally, we have to all look at this geopolitical situation. And then, of course, global investors are still trying to understand how the very positive policy steps that China has taken will play out for some sectors of the economy there, say the tech sector.
Most central banks will tighten their monetary policies in 2022. How will tighter monetary policy affect the market?
The effects of that policy tightening will be to remove some of this stimulus. And I think when you talk about the effects on the markets, the first thing to do is look at history. And typically, if you look at the S&P 500, when the policymakers start to tighten, the stock market can still do very well because the reason that policymakers feel they can tighten is because that economic growth is strong. And, for the first 6 months after policymakers start to tighten, historically, the S&P 500 is up about 5% in the 5 months afterwards. So, that's a base. Obviously, there's always different things and things we're looking at, and how quickly the inflation rate starts to come down over the course of the year will determine when the policymakers can start to ease off on tightening or whether they have to increase. But I think the base case is that the policy tightening in and of itself in the first year of the tightening is not enough to end the stock market appreciation or to shut off country growth or global growth.
China's central bank has started to lower interest rates. How do you comment on it?
We're very pleased, and many people, I think, are envious of the way that China has managed its economy and, very pragmatically dealt with different things that have come up. And I think we're seeing that once again, where, there's many factors that we can't control, things like the pandemic, but also that, China's responded, I think, consciously to, say, levels of debt in the corporate sector, and is trying to move the entire economy to a better place. Now, in doing so, they have to continue to look at what they want to achieve in terms of policy measures, and also how that impacts growth, and to the extent that a bunch of factors, including COVID, have made the growth levels a little weaker than maybe expected. We're seeing China respond to that, and I think it fits in well with our picture for how the year works out, which is that in the first half of the year, the Western developed stock markets probably can perform better because that's where the growth is. But that leadership is likely to shift and could shift more towards China and Chinese markets later in the year.
We all know the US and China's monetary policy is decoupling. How will this affect the stock market globally?
One of the things we talk about is the man with one hand in a bucket of ice water and a man with one hand in a bucket of fire, and whether what his temperature is. I think it does, but it doesn't have to be a bad thing if these policies are worked out at the right level. That as the stimulus recedes in the West, where the growth has been the strongest, if it increases in China, that can really help Asia recover from the pandemic much quicker than expected, provided that the overall level of inflation, does moderate through the course of the year. So I think you have to look at the overall amount of stimulus globally going into the world economy from both China and the United States and Europe, what's happening with the inflation picture, and then what's happening with COVID. And so far the balancing act has worked pretty well, except for this inflation spike. But how that balance continues going forward is very much a focus of our work for the year.
You expect global earnings growth of 10% in 2021. What's your reason for this expectation?
The massive GDP growth that we saw in 2021 fueled much higher earnings, but still, 4.7% GDP growth can still fuel a very robust level of global earnings growth. Now, the caveats to that are still things like what happens with the COVID. But again, if we have seen the COVID rate starting to fall now. The daily case counts say even in the United States and in parts of Europe. And so that can allow some of this reopening, allow different companies to where their earnings have really been hurt by COVID to allow those companies to improve. And especially in Europe, I think this and Japan, which have kind of they're caught between the U.S., Japan, or caught between the U.S., China, and COVID to a degree. We expect those economies and those stock markets, which have lagged, to pick up and provide some leadership to propel that level of earnings growth going forward.
What sectors will have more opportunities?
Well, as we start the year, we definitely want to focus on this reopening trade, and that's leading us to things like Europe and Japan, as I mentioned. It's focused on cyclical plays, financials, energy stocks. But we also are starting to like things in the healthcare sector as a more defensive play as we get deeper into the year and maybe deeper into some of this policy tightening, because healthcare both has defensive characteristics on the big pharma side or the procedure side as more elective surgeries and things can take place again. But it also has that growth component with some of the more biotech focused elements. And healthcare overall is trading at lower valuations than things like, say, technology. So I think that's how we're looking at positioning ourselves in the equity markets for this year so far.
What's your predictions on China's stock market in 2022?
Well, we think that it can, last year was a difficult year for the market, as I can only speak for global investors, but as global investors kind of tried to understand where the reforms and the policy steps that China was implementing, where they would end and what the catalyst would be for a turnaround. But I think we're watching very closely now these stimulus efforts and easing measures in China, along with the reopening, to be things that can help the Chinese market lead, particularly in the second half of the year. So too early to say, I believe, from a global perspective, where we'll end up. But I think it's one of the most exciting areas to put our study into right now. And I'm very hopeful that China can do a lot better this year.
How about the emerging market?
A lot of the focus that we have in the emerging markets for later in the year is going to be in Asia, because they will be led by China. But I think that given that, that's why China's our focus for emerging markets and trying to understand that first. I think that to the extent that there are commodity countries, commodity emerging markets, now is probably a time where we're going to be looking for the ones that are actually able to capitalize on the very strong commodity, very strong commodity growth that we're seeing right now. But I think first and foremost, the emerging market story for 2022 is going to be about the Chinese stock market recovery.
Would you like to give some advices for investors?
The most important thing is to look at your overall portfolio and how you think about how you bucket things. We think about what is the money that I'm going to need over the next few years in terms of liquidity? What is the part of my portfolio that I think about for longevity, that's money that I don't need right away, that I can put to work to grow? And then for those who are very fortunate, what's the legacy that I want to leave? What's the money that I have that I'm not going to need in my lifetime that I can invest really long term for the people and causes and charities and institutions that I want to leave a legacy to? So that's the first step. And then I think that's kind of the strategy that we always talk to people about, the UBS Wealth Way. But then more tactically, I think it's going to be an interesting year where, you can't get too caught up in the headlines around we talk, at least in the United States, about people doom scrolling through social media and people get caught up in the headlines. And we've seen that's not been a good strategy to focus just on the daily headlines. Looking more at things like this interplay of what's happening with growth, what's happening with policy, that's been a much better predictor of what markets are going to do than just very sensational headlines. So people have to have a longer term focus than they do. And that's where we really try to help people with markets and their finances.
We still have a few minutes, so I want to go back to the Fed. Do you think when the Fed will begin to hike rates, and how many times this year?
Yeah, we think the Fed is going to start raising rates probably in March and probably do about 3 hikes this year, which is kind of what the market is anticipating. Actually, the market's now pricing in maybe 4 rate hikes. That I think if our thesis about inflation starting to moderate comes to play, that could actually be a positive for a stock market that's bracing for a stronger set of rate hikes.
All right, thanks, Mark. Without doubt, the global economy will be better this year. However, investors should still pay attention to inflation and the risks of tighter monetary policy. That's all for today's show. See you next time.